time, then I would suggest that Skillshare.
Hello there, this is Uttam. Welcome to my YouTube channel. Today's agenda: investment opportunity of measurement, risks associated over cash flow. I shall explain about standard deviation and coefficient of variance, statistical tools to interpret financial data in real life scenario. Let's start. Agenda: how standard deviation and coefficient of variance is used to measure the business risks. We have got here investment alternative, two proposal. An investor has $40,000 and he wants to identify or measure which investment is more risky and why. For example, investing in coffee shop or house for rent. Let's assume that an investor has got $40,000 and he has got two options: either open a coffee shop or investment in a house which will generate rent for him. Let's move forward. Check it out the first alternative. Investment for a coffee shop. If the investor invested in a coffee shop, he has got 3 years project period. First year $35,000 of cash flow, second year $25,000, and the third year $45,000. And occurrence or the chances of being this cash flow for the first year is 25%, for the second year is 50%, and for the third year is 25%, which is denoted by the P and the C cash flow. And once we multiply this expected year with the corresponding probability and sum it up, we get here expected value or the average cash flow of investment for coffee shop during 3 years. This is very easy. And in order to calculate standard deviation, we have to move some further mathematical process. This is just computation. We assign the value into this formula. C means cash flow and EV means expected value, which is 32,500. C this minus this and square, after that multiply by the corresponding probability, we get this figure. The similarly for the second year, 25,000 minus 32,500 and square, then multiply by the probability, we get this figure. And once we sum it up, we get this figure. That means variance. And the square root of variance is known as standard deviation, which we have calculated here, $8,292. And the coefficient of variance, the formula is standard deviation divided by expected value, is 0.26 or 26%. I shall talk or interpret about this in details in coming slides. So the key point here is to calculation. The alternative one gives this much of cash flow and the probability, and we get the average cash flow or the expected monetary value. Then we calculate the standard deviation and coefficient of variance here. Let's check it out. This another investment proposal for house rent. The same amount of money or same investor wants to invest in a real estate. He wants to purchase a house of $40,000. And the first year, second year, and third year, same time period, and the cash flow from the house rent for the first year is $25,000, and the probability of being $25,000 is 0.25 or 25%. For the second year, cash flow from the house rent is 35,000 and the probability of being 35,000 is 0.45. And similarly for the third year, cash flow from house rent is expected 80,000 and the probability of this much expected cash flow is 0.3%. Once we calculate this cash flow and the probability, then sum it up, we get here expected value or the average cash flow from house rent. Then the same as before, we assign the value or plug the value into this formula and we get here the variance. And once we do the square root of this variance, we get the standard deviation $22,616, which is 0.49 or 49% of expected value. This is calculated just simply standard deviation divided by expected value. If we calculated this 22,616 either in Microsoft Excel or by calculator, we get this figure. Let's go to the summary. Here we have option coffee shop and the house for rent, and total investment 40,000. This means not the 40,000 for coffee shop and house rent 40,000. The investor has total only one mutual exclusive case, or he has only $40,000, and he has two alternative for investment. And this is the average cash flow during the 3 year, which we have already been calculated in previous slide. From coffee shop, average cash flow during the year is 32,500, and house for rent is 46,000. And the standard deviation from coffee shop is $8,292, which is 0.26 or 26% of average cash flow. The similarly, we have got standard deviation here. The most important thing here is to understand is interpretation of what this standard deviation wants to take here. The investor is expected to generate this amount during 3 years, 32,500 from the coffee shop, and standard deviation $8,292 is risk, measurement of risk in cash flow, meaning to say in order to get this much of cash flow the investor has to ready to bear this amount of risk, which is 0.26 or 26%. This is the variation, standard deviation variation. And similarly, if the investor wants to generate $46,000 during 3 years, he has to take a risk of $22,616, which is 0.49 or 49% of cash flow. This is the value after 3 years, and in order to get this much of cash flow, the investor has to ability to bear this much of risks. Thank you for watching. Thank you very much.